Hello. Good morning, everyone. Hello, all. Good morning, everyone. So, welcome to the fifth class of IDT Fast Track Batch CMA final. So, as I said already, we are taking the syllabus in two tracks. One track is in the morning session, and whereas the other track in the evening session. Right? One second. Okay. So we are taking the classes in two tracks. One is like the morning one, and the other one is like the evening session. As I already said, like in the morning session, we are discussing customs. Okay. So if any student who is watching demo lectures in YouTube might be having a confusion, like because class 1, 2, 3, 4, 5 will be taking it in the order, but it's you should understand like class 1, class 2, class 3, class 4, and this is the fifth class. Class 1, it is from track 1 only, we have discussed GST. Class 2 is also from track 1 only, we have discussed GST. Because first 2 days we have only the evening sessions. Whereas class 3, yesterday morning session is from track 2, we have introduced customs. And then yesterday evening, again we are into track 1, we have discussed GST only. And now it is again the track 2, will be discussing customs. Okay. I hope you guys are having this much clarity. Okay. And again, we'll be having evening class also, sixth class. That would be the last class, which would be streamed in YouTube. That would be again from track 1, and we'll be discussing regarding GST only. Okay. So these are the classes which will be available in YouTube. Rest all classes will be available through BCCA app, and I already said about this one. So again, you guys need not to worry about this. Throughout the fast track, we'll be covering or we'll be taking our classes through this handwritten notebook only. And then, if you're having time, then you could think of the other concept book. If you're like a working person or else you don't have much time, then I could surely say is like this handwritten book glancer. Yes, I'm on the face itself I'm saying, on index also I have mentioned, certain chapters are not covered in this, but still this book covers the weightage of 110 marks. If this book along with our applicator, if you prepare, is also very much enough for the exams. Okay. So now let us have a quick recap of the customs topics. Introduction and types of duty. Okay. Article 246. Article 246 actually, seventh schedule of Article 246 gives the power to frame laws. Under that there will be three lists: union list, state list, concurrent list. Okay. So customs is under the union list. Entry 83 of the union list gives the power to central government to frame laws with respect to customs. And then Customs Act was enabled by the Parliament in the year 1962. Customs is not a single act. Customs consists of two acts. One is Customs Act 1962 and the other one is Customs Tariff Act 1975. Customs Act consists of provisions related to charge, collection, assessment, whereas Tariff Act consists of provisions related to like import duties, export duties. First schedule is about import duties, whereas second schedule is about export duties. Then like import, the definition of import. What does it mean by import? Import means bringing goods from outside India to India. Import means what? Bringing goods from outside India to India. And then export means sending goods from India to outside India. Export means bringing goods from import means bringing goods from outside India to India. Export means sending goods from India to outside India. Then India definition. India even includes its territorial waters, which extends up to 12 nautical miles. India even includes its customs waters, which extends up to 200 nautical miles. Beyond 200 nautical miles, it is called high seas. Then the definition of goods. Goods includes vessels, aircrafts, vehicles, stores, baggage, currency and other negotiable instruments and any other kind of mobile property. There is a case law which says like these technical advisors like designs, drawings, okay, those are intellectual properties only and they are intangible assets only. But the moment they are kept into a media like on paper, into a CD, into a hard disk, into a pen drive, into a any other kind of medium, then tangible medium, then it can be called as what? Good. Then coastal goods. Coastal goods, these are not imported goods, but their origin and destination both will be in India. Then assessment. Assessment means what? Assessment means determination of dutiability. You'll be finding out whether a good is dutiable or not. That is, the assessment means determination of dutiability. One step. Then it's not only about determination of dutiability of goods and even the amount of duty, taxes, fee, interest or any other so payable. Assessment means determination of dutiability of goods and the amount of duty, taxes, fee, interest or any other sum so payable. But consider tariff classification, value of such goods. I mean, while doing this assessment, you should consider what? Tariff classification, value of such goods, exemption or concession available, quantity, volume, measurement, and even origin of such goods. Then bill of export. Bill of export is the, hi Yogesh, good morning. Bill of export is the form presented to the proper officer. Bill of export is the form presented to the proper officer to let your goods export is called bill of export. Then bill of entry. Bill of entry is the form submitted to the proper officer. Okay, form submitted to the customs authorities to let your goods import is called bill of entry. Then procedure for import. Any aircraft or vessel coming from outside India should be landed or called for only at a customs station. First point. Then before the arrival of the vessel or aircraft, the person in charge of the conveyance has to file an IGM with the customs authorities. What is called IGM? Import General Manifest. It consists of the details of all the goods which are being carried in that particular conveyance. And then once IGM is filed, the proper officer or the customs authorities will verify that and then they will be granting an entry inwards. On granting entry inwards, the ship will be, okay, on a granting entry inwards, the ship will be coming into the port. The unloading of goods will be allowed only if those goods are mentioned in IGM. And such unloading will also be carried at a designated place under the supervision of proper officer on a working day during the working hours. Okay. However, nowadays, like it is allowed to unload even after working hours also or on a holiday also, but then the importer has to pay merchant overtime charges. Then once goods are unloaded, they remain in the custody of custodian. Once goods are unloaded, those goods remain in the custody of whom? Custodian. For any pilferage, okay, who is called custodians? The port authorities. Once goods are unloaded, they remain in the custody of custodian. So under the control of custodian, if any small kind of thefts are happened, those are called as pilferages. For those pilferages, custodian is only responsible. Then importer of goods, to clear the goods from port, to take his goods, he has to file bill of entry. Bill of entry is of three types. Bill of entry for home consumption. Home consumption means you pay tax. Okay, you'll assess the goods, you'll pay tax and take your goods to your premises. Then that is home consumption. Then the other one is like warehousing. Warehousing means you will not pay duty now. You'll be postponing, or else you'll be postponing the payment of duty. Okay, for a later date. Now you'll be removing the goods from port area and you'll be keeping in the warehouse safely. That is called warehousing. Subsequently, when you are removing the goods from warehouse, then again you'll be filing a bill of entry. Then bill of entry, when the bill of entry has to be filed. Bill of entry can be filed before the arrival of conveyance. Before arrival of conveyance also you can file, but within 30 days from expected arrival date. It can be filed even after arrival, but within next day to the following day of arrival, but then consider only working days. Then within 30 days from unloading, goods has to be cleared for warehousing, home consumption or for transshipment. I mean maximum period the goods can remain in the warehouse is like, in the port area is like 30 days. Then person in charge, vessel master, aircraft commander or pilot in charge. For train, conductor or guard. For any other vehicle, it is driver. For a conveyance definition, it includes vessel, aircraft, vehicle. Then charging section. Charging section, section 12 of Customs Act 1962. Import or export of goods into India is the taxable event for levy of duty. Import or export of goods is the taxable event for levy of duty. Import or export of goods is the taxable event for levy of duty, and further, and the tax has to be levied as per such rates as mentioned in the Tariff Act. Then Upper Industries India versus UAE. Okay, here in this case law, Supreme Court explained what is called import. Import is a process which will commence when the goods cross territorial waters, and it continues till the goods will form part of the mass goods in India. Then here Abenloyd Chills Limited, in this it is a different case law covering a specific circumstance where there are import of goods, but those goods which are imported were not brought into Indian land. Those were consumed within the exclusive economic zone only. There certain oil rigs are located, so the machines or the consumables brought were consumed within the oil rigs. So whether it amounts to import or not, yes. Supreme Court said like exclusive economic zones are also deemed to be Indian territory. So then they are entered into territorial waters, so it can be treated as import. And then what is the taxable event in case of import? The taxable event is like what? It's not the date on which goods cross territorial waters, it's not unloading goods, it's not the date of filing bill of entry, but it is the date when the goods are crossing the customs barriers. It's the date on which the goods crosses the customs barriers. Then we have started discussing about types of duties. The duties can be classified into two types. What are those? Protective duties and revenue duties. Revenue duties, the reason to levy revenue duties itself is to generate revenue. Whereas when it comes to protective duties, the reason is not to generate revenue, but then what? To protect the indigenous, to protect the domestic or indigenous industry. Okay, so what are the types of protective duties? Three are there, sir. One is safeguard duty, second one is anti-dumping duty, and the third one is countervailing duty. Then revenue duties. Revenue duties are like BCD, Basic Customs Duty, AIDC, Social Welfare Surcharge, CVD, Countervailing Duty, Special CVD, IGST, and GST Compensation Cess. Okay, so now BCD. On what value BCD will be levied? On the assessable value BCD will be levied. And then AIDC, okay, it's not quite regular, but if it is given, it is levied as a percentage on assessable value. Social welfare surcharge also as a percentage, but it is majorly what percentage, sir? 10%. Then protective duty. Countervailing duty has to be levied as a percentage, which would be given in the notification. And then safeguard duty, anti-dumping duty. It's not like percentage. They'll be specifying it in the notification. Levy as per the value or the method of computation given in the particular notification. Then CVD. CVD is what? Equivalent of excise duty. Its existence or its purpose has been diluted now because of introduction of GST. It was subsumed majorly into GST. So now CVD, when CVD is leviable on import only, but it is equivalent of excise duty. But currently its scope is restricted only to tobacco, petroleum products and alcohol. The same way special CVD also. You should understand the maximum special CVD rate is like 4% only. Okay. So see, CVD is levied on subtotal, whereas special CVD is levied on subtotal plus CVD together value. Okay. Once this also done, then again you will be doing the total. On this total, you will be levying IGST as well as compensation cess. And remember, out of all these duties, the IGST and cess paid is eligible for availing ITC. So, okay. Now see, basic customs duty. Okay, this also done, sir. Quickly, 1 minute only. Imported goods are leviable to BCD as per the rates mentioned in Customs Tariff Act 1975. But there will be two rates. One is standard rate, other one is preferential rate. Usually, on all these imports, standard rate is only applicable. Usually, on all the regular imports, standard rate is only applicable. But whereas on certain imports, preferential rate is applicable. Okay. When preferential rate is applicable, to apply preferential rate, import must be from to apply preferential rate, import must be from a preferential area notified by government. Import must be from preferential area notified by government. And the goods should be produced or manufactured in preferential area. Goods should be produced or manufactured in preferential area. And then a specific claim for a preferential rate has to be made by importer. So it's not like government itself will provide. You need to ask, okay, for me preferential rate applicable like that. Then the origin of goods can be determined as per the rules frame. You can determine the origin of goods as per the rules frame. Then preferential rate is applicable. Then for exchange rate, sir, I said like it is very, very important, this particular table. What is the exchange rate you should take? Given by CBIC as on the date of bill of entry in case of home consumption. Whereas BCD rate is like bill of entry or entry inwards, whichever is later. Then imported goods warehousing. For exchange rate, take the exchange rate as on the date of in-bond bill of entry. Whereas BCD rate, take the rate as on ex-bond bill of entry. Then we have discussed even the procedure for exports. Okay, procedure for exports. The exporter is required to present electronically. If you are a person willing to export, then through online, you need to file bill of export. Okay, if you are exporting through aircraft or vessel, then you will be filing shipping bill. Okay, once this shipping bill is filed, then proper officer will verify that bill of export or shipping bill and make sure that those goods are not prohibited goods. Okay, even though they are not prohibited goods, he'll check and he'll get himself satisfied that if any export duties are applicable, those export duties are paid. Then if he is satisfied, he'll be giving you let export order. Once the exporter got let export order, then he can take the goods to the ship for loading. But before the goods are loaded into the ship only, the conveyance, the person in charge of the conveyance should apply to the customs office for granting entry outwards. Apply to the customs office for granting entry outwards before the commencement of loading. Then the goods shall be permitted to be loaded only when the bill of export or shipping bill, which is duly signed by the person in charge. Then once loading is completed, again the person in charge of a conveyance has to file EGM, Export General Manifest, which consists of details of all the goods which were loaded into the ship. Okay, electronically to the proper officer. Only on getting a written order from proper officer, conveyance can be permitted to depart. Only after that, the conveyance can be permitted to depart. Okay. So then, BCD rate and exchange rate applicable on exports. BCD rate and exchange rate applicable on export. On export, the rate as on the date of let export order. For BCD rate, which rate you should take? The rate as on the date of let export order. When it comes to exchange rate, take the CBIC rate as on the date of submission of shipping bill. You should take what? CBIC rate as on the date of submission of shipping bill. Okay. Then coming to AIDC. Agriculture infrastructure development, sir. So from here we are starting afresh, sir. Till now, what we have discussed in the last class. AIDC, agriculture infrastructure development, sir. What is the purpose of levying this? This is an additional levy, sir. The government want additional source of revenue, so they are levying AIDC. Whatever the revenue they generate through this AIDC will be used for the purpose of development of infrastructure in agriculture related areas, AIDC. This AIDC is leviable only on import of, this AIDC is leviable only on import of specified goods, and that also at notified routes. What are those specified goods? Apples, gold, silver, alcohol and petroleum products. What are those specified goods, sir? Apples, gold, silver, alcohol and then petroleum products. Understand? Okay? Only on this specified goods AIDC is applicable. It's not applicable on each and every good. Only on specified goods. What are those specified goods? Apples, gold, silver, alcohol and then petroleum products. And then even remember this, there is no AIDC applicable on exports. On exports there will not be any AIDC, agriculture infrastructure development cess. Okay, then coming to social welfare surcharge. Social welfare surcharge also, it is also not applicable on exports. It is only applicable on what? Imports. AIDC and SWS only applicable on imports. Okay, on what values social welfare surcharge has to be levied? It is leviable on aggregate duties of customs. What is the aggregate duties of customs? Means you should take BCD plus AIDC together. On this value you should levy social welfare surcharge at the time of import, not at the time of export. Then the social welfare surcharge rate to be taken is 10% by default. Okay, by default the social welfare surcharge is 10%. However, it is only 3%. It is only 3% with respect to items like gold, silver, platinum, petrol, high-speed diesel oil. With respect to these kind of items, the social welfare surcharge rate applicable is only 3%. Again repeating the items, sir. Gold, silver, platinum, petrol, high-speed diesel oil. These 5 items, it is 3%. Whereas here, if you could see, gold, silver are same even for AIDC and SWS. Okay, and then petroleum products. Whereas here alcohol is coming extra, here platinum and apples here. Okay, so but AIDC is not much important, sir, except for an MCQ. But social welfare surcharge very much needed while solving a question. So social welfare surcharge by default it is 10% and it is not applicable on exports. Then safeguard duty. Safeguard duty is leviable. Safeguard duty is leviable when if on enquiry, central government is satisfied that. So now we are moving toward safeguard duty. When safeguard duty can be levied? Safeguard duty can be levied when central government is satisfied that there are increased imports of such product. What? There are increased imports of such product and such increased imports are causing or threatening to cause serious damage or injury to the domestic industry. Repeating once again, central government on enquiry, it is satisfied that there are increased imports of a product into India. It may be mobiles, laptops or any product. Assume take mobiles. There are increased imports of such product into India. It's not from one particular country. Maybe from any country they are coming. US, UK, China, Vietnam, Japan. From many countries, Korea, mobiles are coming. But overall, the mobile imports into India are increasing. And then it's not, the problem is not just increased imports. The problem is like, because of those increased imports, our domestic those increased imports are causing or threatening to cause serious injury or damage to the domestic industry. Okay, that's the problem. See, there are increased imports and such increased imports are causing or threatening to cause serious damage or injury to the domestic industry. So then safeguard duty will be levied. And then understand, safeguard duty is not leviable on a country wise. It is levied product specific. Which product is having increased imports? I said like mobile, for example. So then only on mobile safeguard duty is levied. It's not like from China. Okay, let's say on mobiles coming from China, safeguard duty is levied. It doesn't mean, it doesn't mean on every good imported from China will levy safeguard duty. It's applicable only on mobile. Even if any other good is also having increased imports, then that good also has to be notified separately for applicability of safeguard duty. Then only safeguard duty is applicable. Hello. Next, safeguard duty levied shall be enforced for a period of 4 years. Once you bring safeguard duty, it will be enforced for how many years? 4 years, and can be extended up to 10 years. The safeguard duty levied shall be enforced for a period of 4 years, and you can extend that period for how many years? 10 years. Next, central government. Okay, sir, here what we said, let central government on inquiry, it should satisfy that. Only if it is satisfied that, then safeguard duty can be levied. So now coming here, safeguard duty shall be enforced. Okay, the safeguard duty shall be enforced for 4 years. But then see, if this inquiry is taking time, okay, so they are taking time to determine the safeguard duty. Already the imports are increasing. The domestic industry is affecting day by day. Okay, seriously, it's getting increased day by day. It's getting impacted day by day. Now, they need to take some action. Okay, they cannot wait till the final inquiry is completed, because the domestic industry is affecting in a drastic way. So then, on preliminary investigation only, they didn't did the full and final study. Just preliminary investigation they did, and in preliminary investigation they believe like there are increased imports, and such increased imports are causing threat to the domestic industry. Central government can even levy provisional safeguard duty on the basis of preliminary investigation. Central government can even levy what? Provisional safeguard duty on the basis of preliminary investigation. Next, on final determination, and then preliminary investigation basis, they introduced what? Provisional safeguard duty. But on final determination, if there is a difference between the provisional one and the final one, okay, provisionally you paid 10 lakhs, but provisionally you paid 10 lakhs. Whereas final determination, it is saying like 12 lakhs. So there is a difference of 2 lakhs, which is deficit. You paid less amount provisionally. So you need to pay now that other 2 lakhs along with interest. Whereas provisionally you paid 13 lakhs, but final determination it is only 12 lakhs. So provisionally you paid more. So the extra amount will be given to you as refund. The extra amount will be given to you as refund. The provisional safeguard duty introduced will remain in force for only for 200 days. The provisional safeguard duty introduced will remain only for a period of how many days? 200 days. Shall remain in force for 200 days. Shall remain in force for 200 days. Provisional safeguard duty shall remain in force for 200 days. Okay. So let me summarize those points once again regarding safeguard duty. Safeguard duty, when it is levied, when there are increased imports, and such increased imports are causing or threatening to cause serious damage or injury to the domestic industry. First one. Then safeguard duty is product specific. Safeguard duty is product specific. Once safeguard duty is introduced, it is for a period of 4 years and can be extended up to 10 years. Right? And on preliminary investigation, if they satisfied then they can levy provisional safeguard duty as well. The provisional safeguard duty will be in force for 200 days maximum. Then there is a difference between provisional safeguard duty and final safeguard duty. There is difference. Then the difference amount has to be paid along with interest. Clear? Then there are certain situations when safeguard duty is not imposed. Safeguard duty is not imposed in the following cases. When the articles are imported by 100% EOU. Articles are imported by what? 100% EOU or SEZ. Articles are imported by a 100% export oriented undertaking or special economic zone. So a unit which is located in SEZ or a 100% export oriented undertaking is importing goods, then on them there is no safeguard duty. Then the share of import of that article originating from developing country. Okay, so let's say there are certain developing countries. Okay, you will be understanding here, sir, with the example also. The share of import of that developing country. You have been importing from developing countries as well as developed countries. If the goods or articles are coming from developed countries, no relaxation, safeguard duty is applicable. But whereas such goods are coming from developing countries, then check what is the share of imports compared to the total imports of that particle of that article. Let's say there are total 1000 crores exports of mobiles into India in a year, 1000 crores. Whereas from one particular developing country A, it is only 5 crores. It is only 5 crores. So out of 1000 crores, 5 crores means, check what is the percentage here. Out of 1000 crores, if it is only 5 crores from a developing country, the total imports of mobiles are 1000 crores. But from a specific developing country, it is only 5 crores, which is less than 3% of the total imports of that articles into India, which is less than 3% of the total imports of such article into India. So in such cases, safeguard duty is not applicable. Okay, then this is, you cannot decide only with this point, sir. You should read this one as well. But there are not a single developing country, there are 4 developing countries. Okay, from one country it is 10 crores, from another country it is, from one country it is 25 crores, from another country also 25 crores, 25 crores, 25 crores, and the balance it is like from other developing countries it is 900 crores. So on this 900 crores, safeguard duty is applicable because this is from what? Developed countries. Now, whereas A, B, C, D are what? Developing countries. Now check the percentage. Total how much? 1000, right? Out of 1000, 25 na? 2.5 percentage, 2.5 percentage, 2.5 percentage, 2.5 percentage. Individually from each developing country, the share of import is less than 3%. But if you look at here, collectively their share is greater than 9%, which is 10%. Collectively their share is greater than 9%. So safeguard duty is applicable on all these 4 developing countries. Safeguard duty is applicable on all these 4 developing countries. Okay. So see here, sir, let us go with an example. Scenario 1 and scenario 2. Okay. Okay. So now look at only scenario 1, sir. Don't look at scenario 2. Okay. So only situation 1. The developing countries are like A, B, C, D, E, and other developed countries are like this. Look at the value of imports from developing countries: 20 crores, 25 crores, 20 crores, 15 crores, 20 crores. From all the other countries, it is 900 crores. If you look at the total imports, 1000 crores. Now, forget about situation 1. Let us take the percentage here. How much, sir? 2 percentage, 2.5 percentage, 2 percentage, 1.5%, 2 percentage. So individually, none of these countries' share is more than 3 percentage. Okay, but collectively, if you check, it is more than 10 percentage. So cumulatively greater than 9 percentage. Safeguard duty is applicable on all the developing countries. Safeguard duty is applicable on all these 5 developing countries. This is what case or situation 1. Now let us move on to the next case, situation 2. Developing country A 35 crores, B 10 crores, C 15 crores, D 25 crores, E 15 crores, and all the others 900 crores, total 1000 crores. Okay. Now if you check, for country A alone, it is 35 crores. Then what is the percentage? 3.5 percentage. So for country A, individually also the share of import is greater than 3 percentage. So on this, safeguard duty is applicable. Now again we need to do cumulatively also, right? So then 10 crores na 1%, 15 crores na 1.5, 25 crores na 2.5, and then 15 crores na 1.5. Now while doing total, you cannot add again this 3.5 percentage. If any company's individual share is, if any country's individual share is more than 3 percentage, then on that safeguard duty is applicable, and again don't include it while doing the aggregation. So okay, where it is mentioned, sir, see, aggregately imports from developing countries, excluding share of import of a country which is greater than 3 percentage. Exclude the share of developing country which share is greater than 3 percentage, and then check cumulatively whether it is within 9% or more than 9 percentage. Okay, so you need to do aggregation, but while doing aggregation, if any developing country share individually is more than 3 percentage, then don't include it. This is about safeguard duty. This is about what? Safeguard duty. Hope you are understanding. See, cumulatively excluding developing country share greater than 3 percentage. Okay, cumulatively excluding developing country share 3 percentage, I mean leaving this one, is within 9 percentage. Hence, safeguard duty is not applies. Only on country A, safeguard duty is applicable. Only on import from country A, safeguard duty is applicable. Hello, are you able to understand? Then we are moving on to anti-dumping duty. Anti-dumping duty. So see, for us to understand anti-dumping duty, first we should understand what is called dumping. What is called dumping? There is a Chinese mobile manufacturer in China. He said like the demand for his units is 1 lakh units. Sir, it's an example. Okay. Then he is producing 1 lakh units, demand 1 lakh units, he is producing 1 lakh also. And the cost per unit for him is like 12,000, whereas he is selling for 15,000 per unit and is making a profit of 3,000. Overall profit is having is like 3,000 units into 1 lakh. 3,000 units into 1 lakh. Now, Priyanka is like a consultant, and then she advised this Chinese manufacturer to double the production. This manufacturer is asking like, if I double the production, I cannot increase demand, right? Supply I could increase, but demand I cannot increase, right? So what will I do with this other 1 lakh units? I'll be again, if those 1 lakh units will become unsold, means I'll be again suffering losses instead of gaining. Okay. So then Priyanka said, yes, believe me, produce 2 lakh units. So he started producing 2 lakh units. Then where is the demand? There is 1 lakh units demand is only in India. There is how much demand? There is only 1 lakh demand, 1 lakh demand only in India, sorry, in China. So now what he is doing, 1 lakh units is selling in China, as he said, as he did previously. Now additionally, the other 1 lakh units is sending to India. Other 1 lakh units is sending to India. Now, just because a new product launch in India, is it that easy to create demand? China itself is selling 1 lakh units. Now, just because he sent to India, will the 1 lakh units will be sold? No, right? Then, for this also he is giving a strategy. Understand what? The cost, because he is increasing the production from 1 lakh unit to 2 lakh units, his cost is coming down to 9,000 only. Because he has doubled the production, his cost is now coming from what? 1 lakh units to, his production doubled. So his cost coming down from 12,000 to 9,000. Okay, but even though his cost came down, his selling price in China remains same. I mean, for 1 lakh units, he'll sell at 15,000 only in China. So whatever is the profit he is earning before that, more than that he is earning now, because previously the cost is 12,000, but now it is only 9,000. So and he is selling it for 15,000 only in China. So that means the profit in China, previously it used to be 3,000 per unit, now it is like 6,000 per unit. Okay, this is about China units. Now coming to India, he is selling it only for 9,000. India, he needs to create demand, right? He just needs to sell those 1 lakh units. He don't want any profit from this 1 lakh units, because already his profit doubled in China because of the reduction in cost. But now from India, he doesn't have market. He has to create market now. He needs to somehow sell this 1 lakh units for him to come out of this. Okay, so that's why he's not adding any margin. He's selling it for 9,000 only. Okay, so now he's selling the same good in China for 15,000, but dumping to India for 9,000. This is called dumping. When you are selling, when you are exporting a product into other country for a price which is less than the market value in that country, then that is called as dumping. So now this person, okay, sending this 1 lakh units to India for just 9,000 is there na, that is called dumping. In India they are selling for break even. This is called as what? Dumping. Okay, so now this anti-dumping duty is not product specific. Safeguard duty is product specific, whereas this anti-dumping duty is country specific. Is what? Country specific. The anti-dumping duty introduced shall be in force for 5 years. Once you introduce anti-dumping duty, it shall be in force for how many years? 5 years. Okay. And this can be extended for up to 5 years. It can be extended for 5 years. Additional anti-dumping duty can also be levied on provisional basis. Just like as safeguard duty, anti-dumping duty can also be levied provisionally. It can be imposed retrospectively also. What does it mean by retrospectively? From a past date also you can introduce it. So retrospectively, but not prior to 90 days. I mean, the retrospective effect can be given only to a earlier date of up to 90 days. Okay. So anti-dumping duty. How do we calculate anti-dumping duty? We'll be calculating the margin of dumping. Margin of dumping. Margin of dumping na, first take normal value. Normal value na, the value at which those goods are sold in China. For what price they are selling in China? 15,000. 15,000. And what price they are exporting to India? What price they are exporting to India? 9,000. So what is the margin of dumping? 6,000. 6,000. Then we need to calculate injury margin. Injury margin na, amount adequate to remove injury to the domestic industry. Sir, understand, if they are selling for 9,000 in India, our manufacturers cannot manufacture such kind of product even for 9,000. Okay, so then this product they are dumping into market for 9,000, whereas our manufacturers cannot produce it for 9,000. Forget about their profit. Cost itself for them will be 10,000. Forget about profit. Their cost itself will be 10,000. So they cannot afford manufacturing that. So eventually they will be losing their share, and that particular China manufacturer only will grab the market, right? So to control this, to protect domestic industry, anti-dumping duty is levied. But how much? The dumping margin. Dumping margin is like the price which they sell in China and then the export price to India. Nothing but 15,000 and 9,000 difference, 6,000. Whereas injury margin, find out at what price our manufacturers are selling. Let's say our manufacturers are selling for 13,000. Our manufacturers in India are selling for, let's say, 14,000. 14,000. Then that product, what is the price it is exported? 9,000. Then it will be having freight rate. Okay, for 9,000 if they sell also, it cannot come for 9,000 because for that freight has to be added. Freight, insurance, all those came to another 1,000. And then customs duties will also be levied. BCD, SWS. Take that also as 1,000. Now how much? This 11,000 is there na. This we call as what? Import price. For the 9,000, the price which they are exporting, add freight and other related expenses that were incurred. And even the customs duty that has been paid. Customs now only BCD and SWS, that also add. Okay, so now 11,000 is the import price. Whereas the domestic industry is selling such kind of products for 14,000. I mean, to bring it to equivalent of domestic industry, then there will not be any problem, right? If the China good also 14,000 and domestic good also 14,000, then customer will choose based on quality or another parameters. So then, if they bring it to 14,000, then we could substantially reduce our injury. So that's why amount adequate to remove injury to domestic industry, which means like 14,000 and 11,000 difference, 3,000. Okay, so this 3,000 is the injury margin, 6,000 is the margin of dumping. Out of these two, whichever is lower, will be levied as anti-dumping duty. Whichever is lower will be levied as anti-dumping duty. Sir, let me take you to the workbook from customs. We'll see if you have any questions. I don't think there are any questions. Okay, you could see I don't have given any questions from this chapter. Types of duty, it's only theory part only. Okay, once again let me conclude anti-dumping duty with a small revision. Anti-dumping duty is country specific, not product specific. Anti-dumping duty is leviable when there are dumping into India. What does it mean by dumping? When any person exporting goods to India at a price lower than their normal value na, the price at which they sell in their exporting country, then anti-dumping duty will be levied. Even this anti-dumping duty can also be levied provisionally if the final determination is going to take time. Once anti-dumping duty is levied, it shall be in force for a period of 5 years, which can be extended further for another 5 years. Then anti-dumping duty can be even introduced retrospectively as well, can be imposed even retrospectively as well, but not prior to 90 days. Then anti-dumping duty will be having, how to calculate, sir? It's like margin of dumping or injury margin. What is margin of dumping? The normal value, the price at which they sell in their country, or export price, out of them the difference. And then injury margin, the import price to India. What is the difference between export price and import price? Export price na, that 9,000. But to find out import price, you should add all other import related costs and even customs duty, BCD and SWS, then that is called as import price. That should be compared with the domestic manufacturer's selling price. Okay, the difference would be called as what? Injury margin. Out of margin of dumping and injury margin, whichever is lower will be levied as anti-dumping duty. Okay, then countervailing duty. The next one is what? Countervailing duty. When the countervailing duty is levied, the countervailing is levied where the duty is levied if the articles imported into India are by getting subsidies from that other country. Let's say from Australia, goods are coming to India. From Australia, the goods are coming to India. Then Australia government is providing subsidies to those exporters. Okay, let's say he's A. Australian government is giving subsidies to that particular exporter because he got subsidy. Because that exporter got subsidy, he's exporting goods to India at a subsidized price only. Whereas our manufacturers didn't got such kind of subsidies, so they'll be selling at full price. Okay, so the amount of CVD, whatever is the countervailing duty they are levying, it shall not exceed the amount of subsidy which they got. If they got subsidy, then to that extent of subsidy only we can levy countervailing duty. To that extent of subsidy only we can levy countervailing duty. Then countervailing duty and anti-dumping duty both cannot be levied simultaneously on an article imported. Sir, because of this subsidy, maybe this good is getting for a lower price. Let's say Australia government is giving subsidy only on exports. So they are exporting goods at a lower price. But whereas in their country they are selling it for normal value, 15,000. But because of subsidy, they are sending it to India only for 9,000. But for the same reason, you cannot levy both anti-dumping duty and countervailing duty. On that, either anti-dumping duty or countervailing duty, only one is applicable. Only one is applicable. Okay. Then subsidy provided should be, okay, when to levy anti-dumping duty, that Australian government is giving subsidy, na, that subsidy should be linked to export performance. I mean, they are saying like in Australia, let's say A is the exporter, right? Now Australian government is giving him subsidy. Okay. The reason for giving subsidy is what? This A should do export. Based on his export, they are giving subsidy. First condition. Okay. Next one. To manufacture goods by A, he should need raw material, right? That raw material A should source it from domestically only. Within Australia only he should buy raw material. He cannot import raw material from some other country. Such kind of condition is inserted. If these two are satisfied, then only and countervailing duty can be levied. Giving subsidy is also not a problem. But giving subsidy is linked to what? That exporter doing export, and he should use raw material only which is sourced from the indigenous sources. Within their country produced raw material only he should use. He cannot buy raw material from other countries. But this fellow can sell to other countries, but he will not buy from other countries. So such kind of export related subsidies are being provided. Then to counter those subsidies, okay, and to protect our indigenous industries, will be levying countervailing duty. So if you remember, we have discussed total how many? 3 protective duties. What are those? Safeguard duty, anti-dumping duty, and the next one is countervailing duty. Right. And the CVD countervailing duty can also be levied on provisional basis. It's not only safeguard duty and anti-dumping duty. Even if it's taking time, this countervailing duty can also be levied provisional basis. Once it is introduced, it shall be in force for a period of 5 years. The countervailing duty shall be in force for how many years? 5 years. And it is extendable for another 5 years. Extendable for another 5 years. Okay? Clear, right? So now, the last concept, sir. Little advanced topic, but we'll understand. Schedule 3 from GST. For us to understand this particular concept, we need to know the Schedule 3 point from GST. Schedule 3 in GST means what? Schedule 3 means negative list. In GST, Schedule 3 means what? Negative list. Negative list. Negative list means what? The items or transactions which are mentioned under negative list are neither supply of goods. These are neither supply of goods nor supply of services. The items which are mentioned in negative list are neither supply of goods nor supply of services. Neither supply of goods nor supply of services. Now look at here. Okay, a person has imported goods, okay, and filed bill of entry for warehousing. And then these goods are kept in warehouse. These goods are remaining in warehouse only. The goods within the warehouse sold to B. And then B again sold to Mr. C, who is finally clearing goods from warehouse. Actually, import is made by whom? A. And A has warehoused those goods. These goods remain in the warehouse only. They were not removed from the warehouse. Within the warehouse only, the goods sold to B and B again sold to C. A to B, B to C. Okay. Now, the concept of selling goods within the warehouse is there. Na? Here, the goods are physically not moving. But instead of A's bond, when warehousing, I already said like a bond has to be executed. Now, A's bond will be replaced by B's bond because now B is responsible to pay duties. Now, with A's bond, B's bond will be replaced. Now, when it is sold to C, then the B executed bond will be replaced by the bond which is executed by C. So, hence, the bond is getting replaced. It is called as bond to bond transfer. Within the warehouse, without removing the goods, if the goods ownership is changed from one person to another, they were sold from one person to another, then instead of the predecessor, the seller bond, the buyer's related new bond has to be executed. Such concept is called as bond to bond transfer. Okay, clear. What Schedule 3 says means here, this kind of bond to bond transfer within the warehouse is not supply. I mean, A selling to B, B again selling to C. Both these transactions are not supplies under GST. Not supplies under GST. Okay, clear. Now, we'll be coming to the customs related. Sir, now see, continuing with this example only. A originally imported and warehoused those goods. How much? 1 lakh value. Then he sold to B for what value? 1,40,000. And then B sold to C for 1,50,000 and ultimately they are removed by C. Now, for customs purpose, assessable value means what? Import price only, right? What is the price it is imported? 1 lakh only, na? So, for levy of customs duty, we should take what? 1 lakh. But who is the one clearing goods? C. The one who is clearing the goods, who is paying the customs duty, on whose name the customs duty is being assessed? C only, right? But for the purpose of calculating customs duty, what is the assessable value to be taken? It's the original import price made by A, 1 lakh. And then BCD at a rate of 20%, 20,000. SWS at a rate of 10%, 2,000. Then the subtotal is 1,22,000. Subtotal is 1,22,000. Now, actually, as per the format, you should levy IGST on what? IGST has to be levied on this 1,22,000. IGST has to be levied on this 1,22,000. Here only the provision comes. The provision which I want to say. See, for levying IGST, subtotal 1,22,000 or value of last transaction. I mean, between A and B 1,40,000 and B and C how much? 1,50,000. That value of last transaction when goods are sold multiple times in warehouse before removal for home consumption. When this concept is applicable, when the goods are sold multiple times before removal from warehouse, then in such case, take the last transaction value or this subtotal, whichever is higher as the value for levying GST. So for levying GST, you cannot straight away take 1,22,000. You should take 1,22,000 or out of these transactions, what is the last value? 1,50,000, whichever is higher. So 1,22,000 or 1,50,000, which is higher? 1,50,000. So you should consider what? 1,50,000. On this 1,50,000, now IGST levied 27,000, compensation cess levy 20%, 30,000. If you look at the total customs duty payable, it is BCD 20,000, SWS 2,000, and then this IGST 27,000 and cess 30,000. Overall, the customs duty payable is 79,000. Overall, the customs duty payable is how much? 79,000. Okay. So this is applicable only when the goods are warehoused, and within the warehouse the goods are sold for multiple times. The goods are warehoused, and within the warehouse the goods are sold for multiple times. Only in such cases this particular concept is applicable. Okay. So now once again look at the format, sir, one last time. For levying customs duty, what we should take? We should take what? Assessable value. We'll be starting with assessable value. How to calculate assessable value we'll be learning in the next chapter. The immediate next chapter we are starting is that one only, valuation. So there you will be learning how to calculate this assessable value. Take assessable value, which is determined under section 14. On this, the first and the prime levy is like BCD. What rate BCD you should take? The rate prevailing on the bill of entry or entry inwards, whichever is later, that BCD you should levy. First one. Then after BCD, if at all there is AIDC, AIDC is leviable only on gold, silver, okay, apples, alcohol and certain petroleum products. Only on them AIDC is applicable as a percentage on assessable value. This also on assessable value, levy them. Then now again SWS will be levying social welfare surcharge. By default the social welfare surcharge is 10%, whereas on gold, silver, platinum and petroleum, high speed diesel oil, okay, on them it is like only 3%. Usually it is like 10% on assessable value. No, 10% on BCD plus AIDC, BCD plus AIDC. Okay, but AIDC is only on import, SWS is also only on import. So BCD, AIDC, SWS. Then you will be levying what? Protective duties. Protective duties. What are those protective duties? Protective duties, na? Again they are like countervailing duty, safeguard duty, and then anti-dumping duty. Countervailing duty alone will be given as a percentage, whereas safeguard duty and anti-dumping duty, they will be mentioned in the notification. So as per that notification, you will be calculating here. Then again you will be doing what? A subtotal. Again you will do what? A subtotal. On doing this subtotal, now if at all CVD or special CVD, CVD under 3 subsection 1, which is equivalent of excise duty, and then special CVD 3 subsection 4, special CVD, if okay, these two has to be levied. This special CVD maximum rate could be how much? 4%. Now on what this CVD has to be levied? On this subtotal, as a percentage only on subtotal levy. Whereas this special CVD on what? Subtotal plus CVD. Subtotal plus CVD you do, and on this if you levy, then you will get special CVD. Then again do subtotal. Again do a subtotal. Again do a subtotal. Then on this you will be levying IGST as a percentage on what? Subtotal. As a percentage on subtotal you will be levying. And then you will be levying IGST cess, not IGST cess, compensation cess. That is also a percentage on subtotal. On subtotal. Now you will be calculating even the IGST. Now if you want to calculate the total customs duty, what you have to do? Total how many duties, sir? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So if you add all these 10 items separately, then you will be getting the total customs duty payable. Total customs duty payable. And out of all this IGST and compensation cess are eligible to avail as ITC. Eligible to avail as ITC. Hello? Are you able to understand, guys? So with this, we have completed the introduction chapter, sir. Now we'll be moving forward to the customs valuation chapter. But before that, you can take a 5 minutes break. If you're sleeping, wash your faces and again be active, because valuation is one of the most important chapter, because definitely there will be a 7 marks question from here. If you're there, just send a hi. It's okay, fine. So we're starting with the topic customs valuation now. So now look at this here, related person. A person when, so we are now understanding the definition of related person. When a person shall be deemed to be related, a person shall be deemed to be related if they are officers or directors of one another's business. If you're following even GST, then it would be much more simpler for two. Okay, if you're following both the tracks, then it would be much more easy for you, because the same definition I even explained in GST, almost same. They are officers or directors of one another's business. Of course, it's fine, even if you start with customs. There's A private limited and then B private limited. And A private limited majority shareholding is by A, and in B private limited majority shareholding is by B. Now, this A from A private limited, A is acting director of B private limited, whereas B is acting director of A private limited. Now, one of them, okay, they're officers or directors of what? One another's business. They are officers or directors of one another's business. They shall be deemed to be related. Okay, they are officers or directors of one another's business. They are officers or directors of one another's business. And then they are legally recognized partners in a business. They are legally recognized partners. I mean, they are partners in a partnership firm, and that firm partnership deed also executed. For that firm, partnership deed also has to be executed. Only then they are called as legally recognized partners. Only then they are called as legally recognized partners. Okay? Then they are employer and employee. If they are employer and employee, and then any person directly or indirectly holds greater than or equal to 5% of voting power. Any person either directly or indirectly holds greater than or equal to 5% of voting power. Directly or indirectly holds greater than or equal to 5% of voting power. But this particular sentence in GST, it would be 25%, whereas in customs it was mentioned as only 5%. It's the only difference in related person definition compared to GST and customs. Okay, any person holds more than or equal to 5%, then they can be called as related persons. Then one of them directly or indirectly controls the others. That means there is holding subsidiary relationship, like that. And then both of them are directly or indirectly controlled by a third person. Sir, if you see, sir, here you said already 5%. If it is control now, definitely the voting power should be more than 5% only, right? Why again you need to tell like control and all? Sir, understand, control can be exercised sometimes even without voting power, sorry, even with 2%, 3% voting power also, certain times control can be exercised. Let's say he is the founder or promoter of that particular company. Now his share is getting diluted because of he accepting like investments, like it's a startup kind of thing. So he started with an idea and with very less capital, but to increase the business he was diluting his share, diluting, and now he is having only 3% only. But still everybody has invested trusting him. The total running management of the company will be did by him only, so he has the control. So since he has the control, it can be called as what? Related persons. And then both of them are directly or indirectly controlled by a third person. Both these people are either directly or indirectly controlled by a third person. Then together they can control a third person. Together they can control a third person. And then they are members of same family. They are members of same family. They are members of same family. They shall be deemed to be related if they are officers or directors of one another's business. They are legally recognized partners. They are employer and employee. Any person directly or indirectly holds greater than or equal to 5% voting power. One of them directly or indirectly controls the other. Both of them are directly or indirectly controlled by a third person. Together they can control a third person, and then they are members of same family. The last one is like through an explanation. When a person is acting as sole agent or distributor of others, where such person is acting as like what? Sole agent or distributor of others. This, if this is the definition of related person, then we are moving towards the definition of bill of lading. So bill of lading is a document given by the shipping companies. Either it could be logistics person. So bill of lading will be given by whom? The shipping company. Logistics company will be providing that. This is like, sir, I have loaded from Australia, my goods are coming. I'm the importer. From Australia, my goods are coming to India. Now, from Australia, my goods are coming to India. Once my goods are loaded in Australia, then as a proof of loading, okay, that particular logistics company will be giving me a document. Then that document, if I want to get it delivered, okay, if I want to take the handover of, I want to hand over those goods, take those goods in India, then I need to submit that bill of lading. Only on submission of bill of lading, they'll be handing over me the goods. Only on submission of bill of entry, they'll be handing over me the goods. So bill of lading is a negotiable document, which means transferable. So this negotiable document can be transferred from one person to another, one percentage to another. Let's say, see here, I was the original importer of goods. I have purchased goods and those goods are loaded into ship and the document also given on my name. But when the goods are in the voyage, in the transit only, I have sold those goods to B, and then B is sold to C. C is the ultimate person who is taking the, who is receiving those goods, who will be taking the goods from the shipping company. Now, I'll be transferring these documents to B. B will again transfer those documents to C. So, whatever is the document given by shipping company is transferable also. That's why it is called as what? A negotiable document. Bill of lading is a negotiable document given by carriers of cargo. Given by whom? Carriers of cargo. I mean logistics company. It consists the details like the port of shipment. I mean in which place they have been loaded. The number of packages covered in the consignment, whether it is like 1 packages or 2 packages or 10 packages, how many packages are there will be mentioned. If any marks and numbers for those packages, like some identification numbers and all, and then name of the vessel in which those goods are being dispatched, because the shipping company, the logistics company might have multiple vessels. We don't know in which vessel they have loaded. So they'll be mentioning the name of the vessel and the name of the consignee, who is the one actually arranged the transport. That one is like consignee. And then whether the freight is prepaid or to be collected at destination, that also will be mentioned. Okay, so the bill of lading is a negotiable document which is given by whom? Carriers of cargo. It consists of port of shipment, number of packages covered by the consignment, marks and numbers, name of the vessel in which such goods are dispatched, name of the consignee of the goods, and then freight, whether it is prepaid or to be collected at the destination. So this document has to be surrendered to the carrier for getting the delivery of goods. You need to do what? You need to surrender this document to get the goods delivered by the carriers of cargo. Then boat charges or light rate charges. Sir, you could see here this Titanic. Titanic is a big ship or small ship? We all know Titanic is a big ship. Okay, don't ask me where is Rose and Jack. Okay, Titanic. So it's not like Titanic, I do know it was sunk. Okay, now it's a big ship. Just to tell you, to have that clarity, like it's a big ship, I have taken the example of Titanic. Some goods are coming, the goods are being coming to India in such kind of big ship. But now this big ship, when it is coming to Indian port, because of extreme weather conditions, it cannot reach the port. Extreme weather conditions, if there is a bad weather, actually during the times of cyclones or when the waves are high, the depth of the sea will be varying. Because of that reason, certain times these big vessels will not come near to the ports. Okay, they'll be staying away like some 1 kilometer, 2 kilometers away from the port only, because once they come to the port, because of this variance in the sea level, that ship may get struck there. So again, they need to pull off this and all additional expenditure only. So that's why it may not come. Or else the other reason is like sometimes they may not find a bay in the harbor. Bay they couldn't get a berth slot there. The port is fully occupied with all the other ships. The ship cannot find a place. So in such cases also, this big ship may not enter into the harbor or port. Then the goods has to be unloaded, right? The importer cannot wait for so long. Then small boats, okay, like this small boats will be used to transport the goods from big ship to the boat. Small boats will be used to transport the goods from this big ship to boat. So whatever is the amount, okay, see here, sir, sometimes vessel is unable to get a berth, then not berth, sir, berth, okay, vessel is unable to get a berth, then the goods are transported from the ship to the shore by these boats. Okay, these small boats are called as boats or even can be called as lighters. Then, okay, the goods are transported from the ship to the shore by boats or lighters. Then the charges paid for them are called as boat or lighterage charges. The charges paid for them are called as what? Boat or lighterage charges. Okay, sometimes a vessel is unable to get a berth, then the goods are transported from the ship to the shore by boats or lighters. The charges paid for these boats or lighters are called as boat charges or lighterage charges. Boat charges or lighterage charges. Are you able to understand? Now we are moving on to section 14, valuation of imported and exported goods. Section 14 subsection 1, here 14 subsection 2. What does 14 subsection 1 says? Like transaction value, valuation of imported and exported goods, transaction value. It is levied at ad valorem duty. There are two types of valuation methods, sir. One is transaction value. I mean, you take value, 10 lakhs, 20 lakhs, 30 lakhs, like that value. Okay, you'll be calculating. On that, if you'll be taking the percentage of BCD rate from Customs Tariff Act 1975. Okay, you'll be taking the rate from Customs Tariff Act, already discussed in the first chapter, sir. Okay, on the transaction value, you levying as a percentage of tax, then that is called as ad valorem duty. It is applied as a percentage on value. When the tax is being levied as like a percentage on value, then that is called as ad valorem duty. Then the next one is like transaction value, tariff value based. Tariff value based, they'll not be levying. Tariff value based, they will not be levying. Tariff value based, they will not be levying percentage directly on the value. But how? It's levied based on the quantity. Let's say there is like on crude oil, I have taken two examples, sir. In the first chapter, I already discussed this point. Crude oil or cigarettes. Crude oil, like on import of crude oil, we know customs duties are leviable. They are not leviable as a percentage. It was linked to like per 1 liter 10 rupees or 20 rupees. Like that they'll fix. So irrespective, okay, it is based on what? Volume. It's not based on the value. And then cigarettes. Cigarettes also, it's not based on the value. It's based on the length of the cigarette. Then, okay, so when the value, the duty is being levied based on quantity, volume measurements, which are fixed by the board, then that is called as tariff value based. Okay, so the valuation for the purpose of levying customs duty is of two types. One is like transaction value based, and the second one is like tariff value based. Hello, are you able to understand? So now we are moving to the value of imported good rules. Value of imported good rules. Under that, rule 1 is like customs valuation of imported goods 2007. And then rule 2 is just about definition. Rule 1 gives the title. What is the title of this rule, sir? Customs valuation of imported good rules 2007. And rule 2 will be having what? Definitions. And then rule 3, here will be covering like what? Transaction value of imported goods along with rule 10. So rule 3 along with rule 10 is the most important part of this chapter, heart of this chapter. Okay. So transaction value of imported goods, you should take what? Transaction value as assessable value. Transaction value of imported goods, what you should take? Transaction value itself you can take as assessable value. But to take transaction value as assessable value, there are 4 conditions to be satisfied. Only if these 4 conditions are satisfied, then the transaction value can be taken as assessable value. First of all, we need to understand what is called transaction value. Exporter. Here importer. This exporter sent goods to this importer at $1 lakh. Sent goods to this importer at what price? $1 lakh. So this is the amount being transacted between them, right? And this is called as transaction value. This is called as transaction value. Sir, is it genuine or not? How could we know? Maybe they got compromised, right? And this 1 lakh value is not the actual amount or not the par amount. Okay, it might be with some abnormal discounts or with some kind of conditions, restrictions and all there. That's why they are saying like take transaction value, this 1 lakh as transaction value. But you need to check conditions. Only those conditions are satisfied. Okay, exporter we take as like Warner. Okay, the exporter name is like Warner. Whereas importer name is like Rohit. Importer name is like Rohit. Okay, so now to take this $1 lakh as transaction value and then levying duties on it, first certain conditions has to be satisfied. What are those conditions? First one, buyer and seller shall not be related. This importer, I mean David Warner and Rohit Sharma, need not to be related, shouldn't be related. Okay, shouldn't be related. If they are related, then because of their relation, this price might have got compromised. This price might have got compromised. So that's what happened, right? If they're related person, maybe they might be selling it for a lower price than what they sell usually. That's why if they are related persons, you cannot take this $1 lakh as the transaction value. First one. Then seller shall not have any control over the imported goods. I mean, David Warner sending these goods, na? He sent goods, I mean imported by Rohit Sharma. Now, David Warner is saying like, these goods you should use only in a specific way. You should only use like this. You should only eat, okay, if they are eatables, you should only eat them while standing. You cannot eat them while sitting. Like this, he is putting certain conditions. So usually, normal, simple example. You went to a grocery store. You gave 10 rupees and bought a Lays packet. Lays packet. The shopkeeper is saying like, you should, okay. So let me recreate the example. You went to a shop and you asked for Lays packet. He given you Lays packet. And then shopkeeper is saying you like, this Lays packet, you should eat here itself. And that also by standing only. You cannot sit there and you cannot give it to someone else. Only you should eat, he's saying. If he's giving such conditions, what you will say? This is my Lays packet. I can eat by sitting, standing, or even by lying on bed also I'll eat. What's your problem? I will eat, or I'll throw into dustbin, or I'll give it to someone else. What is your problem? That's what only you'll say, right? But assume, it's a 10 rupees chips packet, he's giving it only for 2 rupees. He's saying like, I'll give it only for 2 rupees, but you should eat while standing here. Then, anyhow you're getting it for only 2 rupees. You think what? Okay, for 2 rupees only, na? Okay, he's saying some condition, I'll follow. Anyhow, I'm getting for 2 rupees only, right? Then you will be following that particular condition. So, usually, seller shall not put any such kind of conditions. If he is keeping such kind of conditions and the buyer, importer is accepting that means, then there is a question regarding the price. Usually, nobody accepts such conditions. But this person is accepting conditions means maybe price got compromised, right? That's why the seller shall not have any control over the imported goods. He should not put any conditions. He cannot control them. Once he sold, it's the buyer's wish. He cannot again control them. You should stand and only eat. You should sit and only eat. You should lie on bed and only eat. Like that, he cannot put any conditions. Then, third one, price is subject to some condition for which value cannot be ascertained. The price is subject to some condition for which value cannot be ascertained. Sir, again, there is an exporter, there is importer. Exporter sending a product at $500 plus this importer has to promote, sir, this product is like A. Product A has been imported at $500. Now this exporter is putting a condition like, I'll give you product A at 500 rupees only, but he need to promote, I mean this importer need to promote product B also, okay? He cannot just import this product A and sell that, okay? Since he is getting it for 500, additionally he has to pay 500 and he should even talk about product B. If wherever you go, you should tell like product B is super, product B you could use, product B is extraordinary, product B, okay, it's a extraordinary product, like that. Even regarding product B also you should do promotion. A related he will do anyhow because he has to sell A. But not only A related, he has to do product B related promotion also. Now, for this promotion kind thing, whichever he is doing, we cannot ascertain the price exactly. Since you cannot ascertain the price exactly, here there is a consideration. Not only just $500, other consideration is what? Promoting. But for that, you cannot exercise the monetary value. You cannot find out the monetary value. So see here, price is subject to some condition. What is that some condition? Like promoting the other product, but for which you cannot find out the value. If at all you can find out value, then add that value and take that as transaction value, no problem. But you cannot find out value, then price is subject to some condition for which value cannot be ascertained. Then take what? Transaction. Then you cannot take transaction value as the accessible value. So till now three conditions we have discussed. What are those? Buyer and seller shall not be related, and then seller shall not exercise any control over the imported goods. Third one, the third condition is like price is subject to some condition. The price is subject to some condition for which value cannot be ascertained. The price is subject to some condition for which value cannot be ascertained. Okay, then example, from USA a person has imported goods to India. From USA a person has imported goods to India at 100, plus he has incurred other expenses of rupees 50. Now he is selling domestically for how much? 200. Sorry, he has price of 100 and he has incurred other expenses of 50, and then he is selling it for how much? 200. This is the resale price in India. Now the condition is, understand here, the sale proceeds shall not be shared with the exporter. The sale proceeds, I mean, first this importer is paying 100 rupees na, that 100 is only the consideration, but there is a condition like not only this 100, he should pay a share in this selling price also. He is selling for 200 na, on this 10%, maybe 20 rupees also he should pay, but afterwards. Now he'll pay 100 only, but 10% on sale price he'll be paying afterwards. So the total consideration which the exporter is getting is not just 100, he's getting 100 now and other 20 rupees afterwards. So sale proceeds are being shared with the exporter. However, here rule 10 involves and says like much more clearly, if the sale proceeds are going to be shared with the exporter, if the amount to be shared is ascertainable exactly on the date of importation. So today you imported, today only you should have known whatever is the sale price related part you are going to share subsequently. Here the selling price is going to be 200, right? And subsequently if you are going to share 20 rupees, and that is known at the time of importation only, not at the time of sale. Sir, importation might have happened on 15th December 2024, whereas the sale import is on 15th December, whereas sale is happened on 10th June 2025. 10th June 2025. So now on 15th December only you should be able to know how much is the share you are going to give from the resale price, from this 200 resale price, okay? In monetary terms, not in percentage also, in monetary terms. So then if it is known, then take transaction value, the original 100, and even add the subsequent 20 which you are going to add. That itself will be taken as what? Accessible value. Then if it is not ascertainable, sir, how can't be ascertained, sir? You only said like a simple 200 into 10% is like that. No, no. There may be conditions like he has to give 10% of profit, not selling price. After resale, they may put a clause like 10% of profit, and then this particular importer may not be selling it for a fixed price of 200. He may be selling for 210, 190, 185, 170. He may be selling it for different prices. Then in such cases, we don't know exactly what is the amount he is going to share subsequently. We don't know the amount exactly which is going to share subsequently. Then in such case, rule 3 is not applicable. In that case, rule 3 is not applicable. Then what you have to do? You should go for other valuation rules. Other valuation rules. Okay. So what are the 4 conditions are to take transaction value as assessable value? Buyer and seller should be unrelated. Should be unrelated. There shouldn't be, seller shall not exercise any control. The seller shall not exercise any control over the imported goods. Then third one, the price shall not be subject to a condition for which value cannot be ascertained. And then sale proceeds shall not be shared with the exporter. Okay, shall not be shared with the exporter. When will DT fast track classes conduct? DT fast track already about to complete, no? You are asking now about DT fast track. Sale proceeds shall not be shared with exporter. However, rule 10 says like, if the sale proceeds that are going to be shared ascertainable exactly on the date of importation, then take transaction value and dates and add sale proceeds to be shared. If it is not ascertainable, then rule 3 is not applicable. Go for other valuation rules. Hello, are you able to understand? Now we are moving on to the pricings that would be agreed in case of import or export contracts. The pricings that would be agreed in case of import or export contracts. Sir, for us, assessable value means CAF value. I mean cost, insurance and freight. In other words, assessable value means price when it was brought to India. Price when it was brought to India. So you should add all the expenses and then you should bring that price till the point it lands in India. Till the point it lands in India. All those expenses incurred till the point it gets land in India. That total is called as CAF value, which is the assessable value. So now by looking at this particular diagram, we'll be understanding the different kinds of contracts that would be there with respect to see, first of all, this is Australia, right? Hope you knows. Even if you knows, don't know also, fine. I'm writing here. It is like Australia. This anyhow you knows, right? Okay. So don't tell. I don't know this also, sir. In Australia, here there is a factory. Now, sir, every time we need not to mention again and again exporter, importer, you'll get confused. So the one who is located in Australia is seller, right? He's what? Seller. Because he's selling the goods, he's the seller. The one who is in India is the buyer. Okay. Now, this is the seller factory. At factory. Now, this seller is saying like, I will be delivering the goods at the factory gate only. For that only he is saying price. Sir, usually, if I deliver goods at my place only, I'll be charging one price. If I need to deliver to your place, I might be charging a different price. If I need to deliver and install it, then I might be charging another different price, right? That's why at the factory of exporter, nothing but seller. Okay, he will be delivering the goods. Then the price agreed will be there, na? The price at factory gate. The price at factory gate of seller or exporter is called as ex factory price. The price at the factory gate of seller is called as what? Ex factory price. Then from there the goods will be brought from the factory to the port in Australia. The goods are brought from factory to port in Australia. Then the question is, then the contract agreed is like, instead of delivering the goods at factory, the goods will be delivered at the port in Australia, at the port gate in Australia. Then the contract is to hand over the goods at port gate. Then that is called as FAS, which means free alongside. It means what? FAS, which means what? Free alongside. Free alongside. I said one already, ex factory price. Ex factory price means what? The price at the factory gate of the exporting country, at the factory gate of exporter, nothing but seller. The price at the factory gate of exporter or seller. Then FAS, free alongside. What does it mean? The port in Australia, the contract is to hand over the goods at the port gate. In Australia, till the goods will be brought from factory till the port gate and will be handed over at the port gate. Then the price agreed is called as FAS, free alongside. And the third one is like, instead of just bringing them to the port gate, they will be now be loaded into the vessel also. Okay, they'll from factory they'll bring to port, and even in port, if any formalities are there, they'll take care and they'll load the goods into ship. Okay, so then the price when goods are onboarded into the ship, now their responsibility is to till they load the goods into the ship. Then the price agreed will be called as FOB, free on board. So free on board price is the price when the goods are loaded into the ship. Free on board is the price when the goods are loaded into the ship. Ex factory price is the price at the factory gate. At the factory gate, ex factory price. When they are loaded into ship, FOB. At the port gate, it is called as FAS. Then these goods, when they are loaded into the ship, they will be again brought to India after incurring freight and insurance. So the port in India is there na. This is called as port of import. The port in India is called as what? Port of import. The price here in port of import is called as CAF value. Is called as what? CAF value, which means cost, insurance and freight. Okay. When the vessel came to India, at the port of import, they may be charging a price, right? That price is called as CAF, which means cost, insurance and freight, which means cost, insurance and freight. So we are having four terminologies. Ex factory price, the price at the factory gate. FAS, the price at the port gate. FOB, the price when the goods are loaded into the ship. CAF, the price at the place of importation. Okay, so now we'll be understanding it much more detailed way regarding this one. Okay, ex factory price means what? The price at the factory gate of export country, factory gate. How this is arrived? For this you need to add cost plus margin. The manufacturer's cost plus his margin is added, then that is called as ex factory price. Okay, now from ex factory price we'll be coming to what? FAS, free alongside. FAS means what? The price at the port gate, price at the port gate. So what expenses or what items you need to add to arrive from ex factory price to FAS? You need to arrive from ex factory to FAS. What should be added? Take ex factory price and for that add freight in export country. Freight in export country na, from factory in Australia to port, you need to transport them, right? That freight you need to add. Then insurance, along with freight you might be even taking insurance. And if any local taxes in Australia, those three if you add, then you will be arriving FAS, free alongside. Then now where you are there? At the port gate. Now you need to take those goods into the ship. I mean FOB, ship or aircraft. FOB is what? Price on which goods are onboarded Okay, price when the goods are onboarded in conveyance is called as FOB. How do you arrive FOB value? Take FAS value, FAS not till port gate. For that add the loading charges into ship. Loading charges into ship. And if any customs duty has to be paid on export, that also add. By adding loading charges and FAS to customs duty, you will be arriving what? FOB. You will be arriving FOB. Okay. So simple things are, let me quickly once again write for you. First you will take what? X factory price. X factory price. It is the price at the factory gate in export country. For that you will add local freight. Local freight na in export country. Add it. Plus insurance if any in the local country, I mean export country, add that. Plus if any local taxes are there, add that as well. Then you will be arriving what? FAS. You will be arriving FAS. Then for this FAS, you should add what? Loading charges in the port. Loading charges in the port. And if customs is applicable on export, then add that customs duty as well. After adding this two, you will be arriving what? FOB value. After adding this two, you will be arriving FOB. Then here comes the important point, sir. Rule 10 comes into picture and says like, it says or it talks majorly about 6 items. If these 6 items are already included into the value, okay, either X factory price, if they were already considered, then no issues, don't add. However, these 6 items, these are like incidental expenses. These 6 kind of expenses are happening or incurring just because of that import. If there is no such import, then these 6 items are not there. So since these 6 items are incurred only because of that main import, so these also has to be included in the import value. These 6 items also has to be included in the import value. But however, if they were already added, then don't add again. If they were not added, then you should add. So whatever is the FOB given in the question or stated by them, customs will not accept. Customs will again check whether these 6 and other note points, like in note points 1 or 2 extra items will come. You should check whether these are added or not. If these are added, then fine, take it as FOB, call that as FOB customs. If these are not added, then you should add them again. What are those? First one, commission and brokerage if any incurred. Commission and brokerage. Second, sir, detailedly I'll explain in the next class also about these 6 items. Designing cost, commission and brokerage, designing cost. Third one, packing cost. Fourth one, royalty and license fee. Fifth one, free of cost materials if any given. And sixth one, share of sale profits. How many, sir? 6 items. What are those 6 items? Repeat, very important. These are commission and brokerage, packing cost, designing charges, royalty and license fee, free of cost material supplied, sale of share profits. Once again I am repeating, commission and brokerage, designing charges, packing cost, royalty and license fee, free of cost material supplied, and value of share sale profits. After adding all this, you will be arriving FOB customs. But you need to arrive what? The price at the place of importation in India. So this is the price only when the goods are loaded into the ship. So for this FOB customs, you should add freight. Freight na from Australia to India, the goods should reach means freight will be incurred for vessel or aircraft. That should be added. And if any insurance is there, if you add that one, this is the CAF value. This CAF value will be taking as assessable value. This CAF value will be taking as what? Assessable value. Only on this assessable value will be levying customs duty. Hello, are you able to understand? So coming to this format which are discussed here, for FOB, next step is what? You should arrive FOB customs. For that, what you need to add? Commission and brokerage. You should add designing cost. You should add designing charges. You should add packing charges. Only if they are there, if they are incurred, you will be adding. If they are not there in the question, then you will not add. commission and brokerage, designing charges, packing charges, then royalty and license fee, royalty and license fee, and then fifth one you will be adding is like free of cost material provided, free of cost material provided, and free of cost material provided, and then the last one is like commission and brokerage, designing charges, packing charges, royalty and license fee, free of cost material provided, and the share of sale proceeds, share of sale proceeds. All these you need to calculate and add here, add them. Okay, after adding all these you will be arriving FOB customs. Is this the accessible value? No. For this FOB customs, what you should add? Majorly freight and insurance. You will be adding what? Freight and insurance. If you add these two as well, then you will be getting the CAF value, which only called as accessible value for import. Accessible value for import. Whereas if it is export, this FOB customs will only be taken as the valuation. Okay, value. For export, FOB value is the valuation. Okay, accessible value. For import, CAF is the accessible value. For export, FOB value is the accessible value. For import, CAF value is the accessible value. Okay, I hope you're understanding the concepts quite better only. Okay, so we'll meet again in the next class. If you are only following morning session, sir, then the next morning session will be streamed only through BCCA app. Okay, if you are following both the sessions, then the evening session will also be streamed through YouTube. From tomorrow onwards, all the sessions will be streamed only through BCCA app. Thank you.